global marketplace is growing at an incredible rate. International trade in the United States has grown from $200 million per year in 1970 to over $3 trillion a day in 2001. Products from the Far East can be produced, packaged, and shipped to ports around the world in a matter of days. Services unique to America are now available to clients worldwide. Products once associated with a specific country have now become global.
Government economic policies used to be subject to a system of fixed exchange rates, established at the World Monetary Conference at Bretton Woods, New Hampshire. If a country's trade balance went into deficit, foreign central banks would demand gold in exchange for currency. If a nation remained in deficit too long, it would lose its gold and its ability to trade with other nations. But a fixed system not permitted to be responsive to the free market was vulnerable to periodic crises. These crises took the form of sudden devaluations.
The British government today devalued the pound by 14.3%, not only rocking the international financial community, but sending interest rates in London up 2 full points in one day. The
reverberations of the devaluation echoed throughout the free world. Other nations whose economies were closely linked to Great Britain's devalued their currencies as well. The world of fixed exchange rates finally fell apart when the dollar itself, the backbone of the system, could no longer command the confidence of the international financial community.
I directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold or other reserves.
I was there at the time in the government in 1970 and 71 when this thing became acute. And we were considering even stronger measures, such as imposing quotas on imports from Japan in order to defend the dollar. So it was at that point that it was decided that rather than put the economy and the whole world economy through such a ringer in order to avoid all these interferences with international trade and capital movements, the thing was just to let the dollar go down.
I am determined that
Nixon called his action at the time a technical one to stabilize the sinking dollar. But in fact, he had lowered the curtain on the era of fixed exchange rates. Yet even amidst the turmoil of the currency crises, no one was certain that one era had ended and another just begun.
In the 1960s, the foreign exchange traders that I knew then relied awfully heavily for their information on the morning newspaper when they read on the train on the way to work. And if there were not a currency crisis in Britain or France or someplace like that, they might read, there would be a news ticker somewhere in their office that they might look at occasionally, but there was no heavy demand for information about where the market was because the price was fixed.
The market was a totally different market. We did not trade between banks here in New York. We only used to use brokers. We used to trade with our correspondents abroad via telex machines. To make a direct phone call overseas, it used to take probably a half hour because you had to go through the operator. Direct dialing did not exist. With technology today, you can buy $50 million in a matter of 20 seconds.
In 1971, when President Richard Nixon cut the dollar from the gold standard, the foreign currency market averaged about $200 million a year. By 1985, that figure grew to over $350 trillion, and today the figure exceeds $900 trillion a year. There are many reasons for growth in international trade, but perhaps one of the most significant has been the technology responsible for the highly efficient global foreign exchange markets.
Fair to say that the new technology has linked the world into virtually a single efficient capital market. New instruments and further advances in the technology will probably enhance that capability even further and mean that ultimately we're living in a world that's not only economically interdependent, but financially almost a single unit.
Every day, in trading rooms like this at Barclays Bank in New York, more than $200 billion of foreign currencies are bought and sold. Barclays is a major player in this 24-hour global market. This morning, Chief Foreign Exchange Dealer Jack Roche and Senior Dealer for Sterling Steve Leipzig were monitoring their telerate screens when the Saudis announced an increase in oil prices.
Sterling calls, please. The Dormo's out. I'll buy sterling. I'm going to buy about 25 pounds, 60 or better.
An increase in the price of oil could raise the value of the pound. Steve and Jack decide to buy 25 million pounds, speculating that the price will rise. To disguise his strategy from the market, he instructs the traders of the other currencies to call out for prices. He buys his first 5 million pounds, then another, and with each wave of his hand, he will buy 5 million more.
Take 5. 59, 64. No, take 5. I got 5 here. Take 5. I got 5 here. Can I get those tickets real quick? 5 right here.
In less than a minute, Steve has brought 25 million pounds. He waits to see how the market will react.
Wait till the dollar go a little bit lower on that. Where is it now? Got him more? A little higher. It comes back now.
They have guessed right. The price of sterling begins to rise.
I need a couple more calls, all right? You're a little busy.
The pound has risen 1/10 of a cent. Steve decides it's time to take his profit. He instructs his traders to find buyers.
Nothing on 65.70. High already now. Cable, Joey?
Steve also contacts an interbank broker to get bids.
66.71.
Buyer calls begin to come in.
71.
With 2 successive waves in the hand, he sells his first 10 million pounds.
Yeah, sure. Okay, I'm ready up. Beautiful. Thank you, Joey.
A New York broker has sold another 10 million pounds.
20 out? Yeah. I still need calls coming in.
The price has stopped rising. To preserve his profit, Steve must sell off his last 5 million quickly. With another call, the broker has found a buyer for his last 5 million, and he's out.
Right. I'm out.
In less than 3 minutes, Barclays traders have made a profit of $32,000, buying and selling 50 million pounds.
Technology helped create this new and efficient capital market. But what are the implications to business? And how are companies protected from floating exchange rates? One way to insulate a company from currency fluctuation is to buy currency futures. These future contracts fix the exchange rate for a period of time, allowing the company to lock in an exchange rate and avoid losing their profit due to unexpected change in the currency value. International manufacturing companies that are buying and selling products daily have multiple currency risks. Local sourcing is another way to protect profits from currency changes. In the 1980s, the Japanese auto industry took approximately 1/3 of the American automobile market. Reliability, fuel efficiency, and cost effectiveness made the Japanese car a favorite among American buyers. Japan expanded upon its automobile reputation and gained success in exporting many other consumer products. This exporting success increased the demand for Japanese currency from 300 yen per dollar to less than 100 yen per dollar. Honda was a small auto manufacturer in Japan, but had success with its exports to the United States. In the 1980s, Honda took a bold step and became the first Japanese auto manufacturer to set up an assembly plant in the United States.
Ladies and gentlemen, here it comes, the first automobile produced at Honda America Manufacturing, Inc. in Marysville, Ohio. License number USA 001. Official USA 001, Ohio. Automobile driven by Mr. Steve Nakagawa, accompanied by Mr. Bob Reed.
The strategy turned out to be brilliant for Honda. They soon became the #2 Japanese automaker behind Toyota. Honda has recently opened a second plant in Ohio and exports cars to 30 countries worldwide, including Japan. Honda has maintained its reputation for quality, and by producing cars in the United States, Honda avoided the large cost increases associated with importing products from Japan. When the yen tripled in value to the dollar, the result was to triple the cost of products made in Japan and sold in the U.S. Since Honda sourced the majority of its component parts in the U.S., they did not face the same cost increases other Japanese competitors had to deal with. Perhaps the oldest hedge against currency changes is barter. This simple exchange of goods rather than money removes the need for currency protection. Whether a company uses sourcing strategies, futures contracts, or barter, the need to understand and adapt to the world's financial markets will determine the success or failure of tomorrow's businesses.